Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching. This episode, we're going to take a look at how to read a cash flow statement. So I've pulled up Coca-Cola's cash flow statement behind, most recent 10K. I'm just going to walk through some of the line items to see what it is that I pay attention to and how to read a cash flow statement. Cash flow statements are broken up into three sections: operating, investing, and financing. Those three sections. The cash flow statement always begins, at least in the indirect method, with net income. So you'll see net income is always the first thing on the cash flow statement, and that's because it's linking itself to the bottom of the income statement. If you think of the income statement starts with revenue, goes down to net income. Cash flow statement goes from net income to cash balance on hand. And the balance sheet is the bridge between the two. That's how you look at it. The three statements are intertwined. Cash flow is an extension of the income statement, and the balance sheet is the change between the two that is not cash. Okay, let's take a look at net income. So you always start with net income. It's a carryover. You've got depreciation and amortization. Those are non-cash costs that they are expensed in the income statement, that because we want to produce what is cash, you're going to add those back. Those are going to be positive numbers because the building that they built, they paid for many, many years ago, and they're simply expensing it over time, and that expense is a non-cash. We're looking for cash, so it's a positive number. We add it back. Stock-based compensation. Stock-based compensation is a non-cash charge that's expensed on the income statement. We're looking to convert the income statement into cash, so we're going to add that back. It's a positive number. Deferred income tax is taxes that you expense on the income statement, so it's in the net income, but you didn't pay it in cash, so it's added back, or if you did pay it in cash, it's subtracted. The cash flow statement is generally positive for cash coming in, negative for cash going out. Equity method, a loss net of the dividend. This is the adjustment. Remember I said the income statement has the equity method of accounting in it for businesses that Coca-Cola has purchased that they don't own 100% of. They represent them like if they own stock in let's just say they own stock in Apple for some reason. All right, if they had Apple stock price goes up and down. That up and down is represented as an expense, as an income or expense on the income statement. The value of the shares is on the balance sheet, and the cash flow statement says, hey, you expensed an expense, or you recognized a gain on your Apple stock, but you didn't sell it. So you didn't get it in cash. We're going to back that out of the income statement to convert it to cash. Does that make sense? So if you had a gain, let's say you made $1 billion on your Apple holdings for Coca-Cola, hypothetically, you got $1 billion of positive income on the income statement, but it wasn't cash. This starts with net income. So this net income has the positive $1 billion of cash in the net income, but it didn't happen, so you got to back it out. That's what this is doing. Foreign currency adjustment, same thing. It's updating the cash flow for the conversion of global sales to the reported dollar functional currency that Coca-Cola uses. Significant gain or loss on assets. This is just selling assets and gaining or losing money. Other operating charges or working capital. It's cash that's needed to run the day-to-day operation. So it's measuring the change in the inventory levels and change in AR, AP. These changes in the balance sheet, for example, if I bought inventory, if I put out cash for the inventory for Coca-Cola, but I haven't sold it yet, it's not represented in the income statement because I haven't sold it, but it's sitting on the balance sheet because I bought it. It sits in the cash flow statement as a way to make sure the balance sheet is truly representative of the business because you paid out for inventory. Coca-Cola consolidates all this into one line. I wish they broke it up. It looks at changes inventory on the balance sheet, changes of AR on the balance sheet, and changes of AP on the balance sheet. Those three are generally the biggest ones, and they're sitting here in other operating charges. Other items, and then net charges, net change in operating assets and liabilities. Those are kind of the working capital numbers, and you want to watch those and try to normalize them over time. You look at the dollar amounts here, and you say, you know what, this is really, really big, $1.3 billion. It was a whole lot less before. I might want to bring that down in my forecast more towards these numbers, depending upon how I think they're going to invest their money going forward. Cash flow from investing, the second section, the middle section of the cash flow statement. The first is going to begin, and this order will change depending upon what company. There's no right or wrong order here. They happen to begin with purchase of investments and the proceeds from the disposal of investments. This is them rotating their treasury over the marketable securities line that they have and the short-term investments line. This is them saying, I'm buying these treasuries, or these treasuries matured and I got the cash from those. Generally, they're kind of offset each other. I wouldn't pay too much attention to this because it's represented in the balance sheet. It's kind of normal operations for them. Acquisition of businesses using the equity method. This is acquisitions they're making that aren't consolidated on the business. So if they go buy long-term, if they buy 10% of Monster Beverage, that would be here. But it's not a purchase investment. Purchase investment for them is the treasury bonds. It's related to the cash they keep on the balance sheet, not an equity investment of a business, which is much more long-term. Proceed from the disposal assets from the equity, that's just them selling. So this is buying equity investments, this is selling equity investments. Purchase of property, plant, and equipment. This is them buying the CAPEX, the capital expense, the business, the machinery and equipment they use to run their business day to day. And it's the most important thing you want to pay attention to. This is how much money they're putting back in the business to make sure that the cash machine is continuing to run. Proceeds from the disposal of property, plant. They're just showing, hey, I sold this equipment because it was old, I wanted to replace it. And then other is generally other. That's the total investing section. And out of there, you really want to focus on, are they making acquisitions regularly? Is that part of them growing their earnings and required for them to do? If they do it every year and it's a big piece of their thing, it might be how they're growing their business. Number two, the purchase of property, plant, and equipment. You want to watch that because many companies, to generate more cash, will cut back on purchase of property, plant, and equipment. And what that means is that over time, their businesses and their equipment will get older and older and older, more and more out of date. So there's a looming big cost that they need to go to refresh everything, and they're not keeping up to date. It's good in the short term. It boosts cash flow. The stock price is going to run up because people think they have a ton more cash. But over the long term, it's going to hurt the business because that bill eventually comes due. That's the cash flow from investing section. Okay, the final section, cash flow from financing section. In here, you're going to find issue and sale of stock, dividends, and debt payments. It's going to start with the issue of debt payments. Debt payments are generally the top section here. It's going to be issuing debt and paying debt. It's principal only. There's no interest here. Interest is in the income statement unless the interest is paid in kind of debt. It's called PIK interest. It's different. But in general, it's only principal payments. So here, issuance of debt, payment of debt, they issued $13 billion. They paid down $13 billion. They're clearly just revolving their debt. That's all they're doing. They're not really paying it down. They're not issuing more. They're just rotating it. Because, say, a bond came due in 2021. It was like a 5-year note they issued 5 years ago. It came due. They issued another 5-year note to pay that one off, and they just roll the debt. Debt payments. Let's see, the issuance of stock. That's them selling common stock. That's in the employee plan, right? They might sell stock. They might sell stock to raise capital. If they need business, they can't borrow debt, they'll sell stock in the open market. This is the cash that they generated from selling the stock. Purchase of treasury. That's them buying stock and canceling. If they're buying back a ton of stock, you'll see that here. That's very good to see. And dividends. What are they paying dividend? Now, it's interesting to note, most of what they do here in this line is paying the dividend. And they actually buy back very little stock. So their dividend is $7.2 billion annually, but they only buy back $111 million worth of stock. A lot of people value a company based on its dividend yield. And in this instance, their dividend yield is not different much from their free cash flow because most of the free cash flow is going to dividend. You will see a lot of stocks, if you keep looking, where this number in stock buyback is significantly higher than dividend. And a lot of mistakes that retail investors will make is they'll look at the dividend yield and they'll rank companies by dividend yield. But that's only half the battle. The real picture is how much cash in total are they giving back to the investors from stock buyback and from the dividend. So you want to add these two up. They're negative numbers because they're outflows of cash to you, the equity holder. You want to add these up and look at them on a combined basis. That's what I try to do on the channel when I talk about free cash flow. I'm looking at all the free cash flow they have. Whether they give it to me as dividend or they go back buy back stock, I'm indifferent because it's my ownership of it. But if you look at only the dividend, you're missing the big picture. So after that, you've got the net change, net increase, decrease in cash. That's the addition of the CFO, cash flow from operations, cash flow from investing, and cash flow from financing. Those three are combined here. Beginning cash balance, what I started with, add those two up, I get ending cash. And that cash ties to the cash on the balance sheet, so all the statements are linked. Remember, the cash flow and the income statement are measures over time, over a period of time, from a quarter or for a year. The balance sheet is a point in time. So what you'll have is you'll have a balance sheet last year, you'll have a balance sheet this year, 2 points of time. In this case, I think they're December 31st, let's just say. So you have December 31st last year, December 31st this year. You've got the income statement and the cash flow statement, which span the months in between those two statements. And they bridge the change in balance sheet here to the change in balance sheet here. That's the idea. Income statement and cash flow statement are always measured over time. Balance sheet is measured at a point of time. All right. I hope you enjoyed this. This is how to read a cash flow statement. Thank you very much. Bye-bye.